Joining us live now, independent analyst Evan Lucas. Evan, good to see you. Thanks for your time this morning. So we're talking cuts now, all of a sudden, and multiple cuts this year, and maybe even coming to effect May, June, around then. Are you that ambitious for mortgage holders?
I wish I was. No, I'm not. I think June's a relatively positive view to have the idea that the RBA could cut rates then. It's more likely, though, that it'll be in the very latter half of the second part of this calendar year. So I actually don't think they'll start till September. That gives them a full half of data to go with. Now, we've already seen, as you've already alluded to this morning, data at the second half of last year was falling and falling rapidly. I think what's also slightly missed by yesterday's inflation number was that the September quarter, which they used as justification for rising in November, was significantly downgraded from 4.3% to 4.8%. So that is also something to be aware of. So we are moving very quickly, very rapidly into the inflation numbers, but we are still technically, 1.1% away from the top of the band. They need it to be more likely 2.5% and still falling to be really satisfied they're there. So for that reason, I'm not so, positive that it's going to happen, in May. I will point out this, though, and this is the other thing. Don't forget, next Tuesday is going to be not just about the RBA meeting itself, but we're looking at Michelle Bullock outlining everything for this year, including when the 8 meetings are and all the other recommendations that happened in 2023. They come into effect next meeting. So it's a lot of data.
Yeah, that's true. Worth remembering, we're not going to have as many RBA meetings this year. I think it's a safe bet, though, isn't it, Evan, that there's not going to be a rate rise next Tuesday, right? Are we betting on that?
That's more than a safe bet. There is every sign now that, raising further from what the IMF said last week looks quite ridiculous. If you've got, retail sales falling 2.5%, once you take into, the quarterly movement from October through to December, retail sales is down about 1.5%. Inflation is falling at the fastest rate since, the end of COVID. So all of those things would mean, yes, we're locked in. And even with the stage 3 tax cuts and the debate around it, the gradual impact of them will be marginal. It's not next year, this, 24, 25. My issue, as I said last week when we talked about this, it's 25, 26 and 26, 27 when inflation pushes up further up the bands. And therefore we go through the one to watch is the 135 band. Now that we go into 37%, that is where the bracket creep problem kicks in.
Yes. So this leads me to my next question. And this has been raised by Shane Oliver as well. Will Labor's rejigged tax cuts delay those interest rate cuts, in your view?
Possibly. Again, if you look at what they released from the Treasury last week, there's a lot of very, very, smart accounting. I think that's the polite way of saying to you. So they are banking money in 23-4, which is why they can show that it won't create inflation pressure. But if you look at the figures, they're going to take about another $26 billion, $27 billion of tax returns. But they also show that the response on the lower end of the socioeconomic groups with the lower bands will be higher than what was forecasted under the previous stage 3 tax cuts. So like I said, I don't think they'll delay them. It's more about, my concern is next year. 25, the forecast in the market was foreseeing up to 4 rate cuts, for next year factored in. That could actually be scaled back to 2 because that impact is there, that stimulus effect is there. So it's not now, it's next year that I think that will really play out.
Yeah, because you've got, all these folks at the lower end of the scale are now permanently going to have more money in their pockets, and traditionally they spend it. They don't save it.
Yeah, and it takes time, right? So it takes 12 months to filter out. Again, perfect time for everybody to be having a tax cut in their back pocket, because this time next year, we will probably be starting an election cycle. We will actually be going through the whole thing. And if you turn around, particularly if you're between $80,000 and $120,000, you're going to have between $2,500 to even as much as $3,500 extra in your pocket from those tax cuts coming to effect about now next year through to the end of September when you do your tax return. That's why I'm not worried about delayed for this year. It's next year, and what the RBA has to turn around and go, actually, we've got to stop now because the stimulus is happening from fiscal rather than from monetary policy side.
Interesting. As always, Evan Lucas. Well done. We'll talk to you soon, Evan. Thank you.